These 4 investing mistakes cost people millions over their lifetime, and most don't even realize they're making them. You think you're being smart with your money. You're investing. You're planning for the future. But if you're making any of these mistakes, you're sabotaging your own wealth. Mistake 1, trying to time the market. Mistake 2, paying too much in fees. Mistake 3, panic selling during downturns. Mistake 4, not diversifying properly. These mistakes are silent wealth killers. They compound negatively over decades. And by the time you realize what happened, you've lost hundreds of thousands of dollars. Let me break down exactly what each mistake looks like and how to avoid it. Investing is how you build real wealth, but most people approach it wrong. They make emotional decisions. They follow trends. They overcomplicate things. And they lose money in ways that aren't obvious until it's too late. These 4 mistakes are the most common, and they're completely avoidable if you know what to look for. Mistake number 1, trying to time the market. This is the belief that you can predict when the market will go up or down and trade accordingly. Buy low, sell high. It sounds simple, but it's impossible to execute consistently. Even professional investors with teams of analysts and advanced algorithms can't do it reliably. Yet individual investors think they can. Here's what happens. The market is at an all-time high. You think it's overvalued, so you wait for a crash to buy in. But the market keeps going up. You miss out on months or years of gains. Then when it finally does crash, you panic and don't buy because you're scared it will drop further. By the time you feel comfortable buying, the market has already recovered. You've missed the entire run-up. Or worse, you try to time it the other way. You see the market going up, so you jump in. Then it crashes. You panic and sell at the bottom, locking in your losses. Then you watch it recover without you. This cycle repeats, and you never actually build wealth because you're always on the wrong side of the timing. The data is clear. Time in the market beats timing the market. A study by Charles Schwab showed that even if you invested at the worst possible time every year, right before every crash, you'd still be better off than someone who stayed in cash trying to time the perfect entry. Why? Because the market trends upward over time. Missing the best days costs you more than enduring the worst days. The solution is simple. Stop trying to time it. Invest consistently regardless of what the market is doing. Use dollar-cost averaging. Invest the same amount every month. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this averages out, and you stay invested through the ups and downs. That's how you build wealth. Mistake number 2, paying too much in fees. This one is insidious because it doesn't feel like a big deal in the moment. A 1 or 2% management fee doesn't sound like much, but over decades, it's the difference between retiring comfortably and running out of money. Let's look at the math. You invest $10,000 and contribute $500 a month for 30 years. With an average 8% return and a 0.05% fee, you end up with about $745,000. Now let's say you're paying a 1% fee instead. You end up with about $640,000. That's a $105,000 difference. Same contributions, same returns. The only difference is fees, and that's at just 1%. Some actively managed funds charge 2% or more. The damage compounds. So why do people pay high fees? Because they don't realize what they're paying. Fees are often buried in the fine print, or they're sold on the idea that an active fund manager will beat the market and justify the fee. But the data shows that over 90% of actively managed funds fail to beat their benchmark index over 15 years. You're paying more for worse performance. The solution is to invest in low-cost index funds. Funds with expense ratios below 0.1%, VOO, VTI, SCHD. These funds charge almost nothing, and they consistently outperform the majority of expensive actively managed funds. Every dollar you save in fees is a dollar that compounds in your account. Over a lifetime, this difference is massive. Mistake number 3. Panic selling during downturns. The market crashes. Your portfolio drops 20, 30, maybe 40%. You watch your balance shrink every day. The fear is overwhelming, so you sell. You want to stop the bleeding. You tell yourself you'll buy back in when things stabilize, but you never do, and you lock in your losses. This is one of the most destructive mistakes you can make, because market crashes are temporary. Market recoveries are permanent. Every major crash in history has been followed by a recovery and new all-time highs. The 2008 financial crisis, the 2020 COVID crash, the dot-com bubble. If you stayed invested through all of them, you made money. If you sold at the bottom, you lost everything. Here's the psychology. Losses hurt more than gains feel good. This is called loss aversion. When you see your portfolio down 30%, the pain is intense. Your brain screams at you to stop the loss, but selling at the bottom is the worst thing you can do. You're selling low, which is the opposite of what you want. The investors who build wealth are the ones who ignore the noise. They don't check their accounts during crashes. They keep investing. They buy more shares when prices are low, and they trust that the market will recover, because it always has. If you can't handle seeing your portfolio drop 30% without panicking, you need to either adjust your risk tolerance or stop checking your accounts so often. The solution is to build a portfolio that matches your risk tolerance. If you can't stomach big drops, hold more bonds and less stocks. Accept lower returns in exchange for stability. But if you want higher returns, you have to accept volatility, and you have to commit to staying invested through the downturns. That's the price of long-term growth. Mistake number 4, not diversifying properly. Some people think diversification means owning 10 different stocks. It doesn't. If all 10 of those stocks are in the same sector, you're not diversified. If they're all US companies, you're not diversified. True diversification means spreading your money across different asset classes, sectors, and geographies. Here's why this matters. Let's say you put all your money into tech stocks because tech has been hot. Then the tech sector crashes. Your entire portfolio gets wiped out. If you had spread your money across tech, healthcare, energy, international stocks, and bonds, the damage would be limited. One sector crashing doesn't destroy your wealth. The easiest way to diversify is through index funds. A total stock market fund like VTI gives you exposure to over 3,500 companies across all sectors. An international fund like VXUS gives you exposure to thousands of companies outside the USA bond fund like BND gives you stability. With just 3 funds, you can build a diversified portfolio that covers the entire global market. But people don't do this. They chase individual stocks. They put all their money into one hot company. They concentrate their bets because they want to get rich quick. And sometimes it works, but more often it doesn't. And when it doesn't, they lose big. Diversification isn't sexy, but it protects you from catastrophic losses. And in investing, avoiding big losses is just as important as capturing big gains. The solution is to stop trying to pick winners. Buy the entire market through index funds. Accept average returns, because average returns in the stock market over decades make you wealthy. You don't need to beat the market. You just need to match it, and diversification ensures you do. Here's the common thread between all 4 mistakes. They're driven by emotion, fear, greed, impatience, overconfidence. Successful investing requires you to control those emotions, to make logical decisions based on data and principles, not feelings. When the market crashes, your emotions scream at you to sell. Logic tells you to hold or buy more. When a stock is skyrocketing, emotions tell you to jump in. Logic tells you to stick with your diversified plan. This is why most people fail at investing. Not because they don't have money, not because they don't have access to information, but because they can't control their emotions. The investors who succeed are the ones who can stay calm when everyone else is panicking, who can stay disciplined when everyone else is chasing trends, So here's what you do. Set up a simple, diversified portfolio of low-cost index funds. Automate your contributions. Invest the same amount every month regardless of market conditions. Don't check your account constantly. Don't try to time the market. Don't panic when it drops. Don't chase hot stocks, just stay the course. Boring wins in investing. Consistency wins. Discipline wins. If you can avoid these 4 mistakes, you'll build more wealth than 90% of investors. Not because you're smarter, but because you're not sabotaging yourself. That's the real secret. Wealth isn't built by making brilliant moves. It's built by avoiding stupid ones. That's wealth mode. If this video was helpful, please click the subscribe button and then like and share with your family or friends.